All right, then that's the word coming in from the NSE chair. But now let's move on and welcome our guest, Jignanshu Gor, who's the Director and Senior Research Analyst at Bernstein, India. Thank you so much, Mr. Gor, for joining us. So let me first start by asking you, how are you viewing the current market scenario? The benchmarks have been trading in a narrow range. So do you see this as a pause before a breakout or signs of fatigue in the rally?
Thank you for having me here. On a broader market, I would say
Hi, very good afternoon, Jignanshu. Sorry, this is Shrishti also joining in. That's a very crucial development that we are literally planning to discuss with you, and that is on ABFRL. That's the demerger that everybody is talking out for. Give us some sense, Jignanshu, that what's really in store for the shareholders? How can it actually create value for the shareholders? Because as we understand that Aditya Birla Fashion Retail Limited, as well as the other brands, lifestyle brand, will actually get demerged. So give us some sense that how will this demerger pan out and what could really be in store for the shareholders?
thank you for having me here, Srishti, and let me uh, give a bit of context on the two companies that are emerging out of this corporate action. So you have Aditya Birla Fashion and Retail Limited, which has a wide array of brands and retail outlets, everything from traditional menswear, formal wear brands, workwear brands like Louis Philippe, Van Heusen, Alan Solly, Peter England, including then you have Reebok and American Eagle as well. So that those workwear brands, larger brands, will form part of Aditya Birla lifestyle brands, which is being delisted, which has been delisted now, and will start trading as and when the script for that is issued in a few weeks' time. What is left right now is Aditya Birla Fashion demerged, which will have pantaloons. It will have all the ethnic wear brands, including the recent acquisition of TCNS, the more premium brands like Masaba, Jaipur, and the designer brands like Tarun Tehliani, Sabyasachi, Nikhil and Shantanu, and Nikhil, etc. Right, including the digital first brand. So I think it remains a conglomerate of brands by itself. I think the thesis behind creating two different entities was because they are companies which have two different objectives and they need two different strategies, and hence possibly two different sets of investors who would be interested in investing there. We think that strategy is not necessarily playing out by itself, but the individual companies will need to demonstrate growth in order for re-rating. And we thought that the price is not depressed only because of different ownership, but it's also because fundamentally they have not performed as much as some of the peers in the industry have. So our expectation is the corporate value creation for shareholders will not be automatic just because of the demerger and corporate action. It will have to follow performance improvement in their individual companies, which we watch very closely as over the next few quarters.
But Jignanshu, there could be some challenges as well, like you were also highlighting in your report, and you have mentioned that the value creation won't be automatic post the demerger. Give us some sense there that what does it really mean, and could you elaborate on the risk or the execution challenges regarding the same?
Sure. So when I say it will not be automatic, typically a demerger, the reason for doing a demerger is that a combined entity is being given a corporate discount, right, or a conglomerate discount. This discount is because of two broad reasons. One is different parts of the company are operating in fundamentally different parts of the industry or in fundamentally different industries, and hence the capital allocation and the strategic decisions which are being done are sort of a black box for shareholders, right? And hence it's difficult to provide a value which is equal to the best of the companies in those specific industries. I think the best case is that of Sanofi, which we don't cover, but which listed last year and split into a consumer business and a pharma business, which have very different underlying trends and drivers. And hence it's that kind of a corporate action demerger led to a significant increase in value for the Sanofi shareholders. In the case of Aditya Birla, we think that the two businesses are relatively similar to each other, and that they are essentially apparel retail businesses, combination of brand and retail in both cases. There is, in fact, I would say, competition between the brands that exist under the two businesses now. There is cross sell of Aditya Birla one business brands into, let's say, pantaloons. So it's not a fundamentally different business, or in a different industry, or in a different geography, right? It's not been very difficult for investors to give a different sum of parts valuation, which means the true valuation is already part of the business, and hence, of it's difficult to see investors in large quantity being interested in only one part of the business and not interested in the other part, and hence lead to automatic re-rating. So we think the re-rating will come from business itself and their performance. We think their performance depends on execution, which hasn't been great compared to some of the other companies over the last 3 years or so. Starting with capital allocation, acquiring a lot of retail brands, which adds financial leverage in an industry which already has significant operating leverage. So that has put pressure on their financials, and they have been making losses as a consolidated entity for the last 4 years, 5 years. So till they can draw, what they need is on the ABFRL demerged, a combination of growth and profitability. More focus on profitability here, given Pantaloons has struggled, given TCNS has struggled, given Tomorrow is also loss making. And on the lifestyle brands, which will start trading in a few weeks, it's a very profitable business. It's a very it's ROE is very high, but they need bringing to bring back growth. So I think those are the two struggles: one growth, one profitability. And until they can show that for a few quarters, we think re-rating is dependent on that rather than just on demerger.
Right, to totally take your point, but Jignanshu, many of the lifestyle brands within ABFRL, the brands operate in a relatively mature categories, men's formals, sportswear. In your view, where can this business carve out the new demand or defend margins in a low growth environment? Do you believe that this business can actually do well to actually protect its margins?
Yeah, so it's going to be tough, right? Because as you said, at a category level, men's formal wear is mature. It's not growing. In fact, there is a transition happening in men's formal or men's workwear from formal to more casualization on at least one day a week, which means 20% of the market, or probably more. And in newer industries, the wear is even more casual, right? So one thesis that can play out for them is they have had a lack of innovation, because a lot of the capital which these brands have generated over the last few years has been pushed towards either acquisitions or pushed towards innovations in the other brands. So if that capex or that investment is plowed back into the lifestyle brands in the right way, they can grow a little, but I think it will be largely base effect led, because the last couple of years has been bad. So my view is it is going to be difficult for them to sustainably drive high teens kind of a growth in those brands over the next 3 years. Uh, uh, Unless they can able to do that, they can do that. Bringing back belief in backing those brands and giving them a much higher valuation multiple is very challenging in my view. Uh, One potential way is adding distribution network, because their presence is can be sort of extended beyond where they are. But again, structurally, I think it's going to be challenging for them to bring back growth for a very long duration. In this, they need to add more business segments. Uh, and betting on Reebok and their Van Heusen innerwear segments is where I think there is a lot of effort and for potential for growth. I think we need to
Jignanshu,
see at least 3-4 quarters of growth before we can
all right.
start. Just yeah.
All right, but Jignanshu, we do understand that you have been holding an underperform rating on this particular counter all this while. So let's look out for the demerger and the factors that could be at play you just highlighted. But Jignanshu, since we have it with you, quickly if you can help us with the trends that you are picking up within the retail side, because we also know that for Trent, DMart, these been your favorites of late. So with the earnings that have gone so far, what kind of a trend are you penciling in for the upcoming quarters?
See, I think while Q4 is typically a slower quarter for most retailers, Q1 does well for both DMart and Trent, and the reason is for DMart, Q1 is the coming back to school quarter, which helps their general merchandise sales go up, which is positive. For Trent, given the amount of stores of Zudio and Westside that they have added in Q3 and Q4 last year, were not meaningfully revenue accretive in the last year, and they will become increasingly higher contribution of revenues in Q1 and Q2. So because of those specific reasons, I think Q1 and Q2 will be good for both DMart as well as for Trent. And structurally, I like them because they are a very clean operating model with a very narrow focus on a customer profile and a product profile, focusing on replicability rather than breadth. And I think that is what differentiates a strong retailer from a weak retailer in my view.
All right, Jignanshu, with this we let you go. Thank you so much for taking the time out and helping us understand what this demerger really means and what could really be in store for the shareholders. Appreciate that.
Thank you so much for having me. Look forward. Cheers.
Thank you so much.